The important thing to understand, so investing is all about timing. It's a very disturbing propaganda mechanism to conflate these issues because no regulator regulates technology. Regulators regulate the behavior of people within their jurisdiction. The utility is great. The utility is about 100 times that of the US dollar within that use case.
Emerging technologies are an extremely fascinating topic. However, it takes great care and skill to find the next big thing, discover its feasible implementation, and the team able to do the breakthrough. Today, we invited the master of this craft, Christian Kameir. He invested in breakthrough technologies since 1999 and became interested in blockchain in 2014. Now he is a lecturer at multiple universities and founder of the venture fund investing in disruptive technologies in Web3 and DeFi. Christian, I am so glad that you are joining us today.
Well, thanks for inviting me to this interview.
Welcome everybody to the Stobox Interview, a video series where we bring the best of the best to discuss the future of crypto, tokenization, and capital markets overall. I am your today's host, Boris Pikalov, co-founder at Stobox. Please don't forget to subscribe to the channel and turn on notifications so that you don't miss opportunities for learning from other great interviews we have. And now let's proceed straight to the interview. Christian, please tell us about your background and current projects.
Well, first, the obvious, the funny accent originated in Germany. I was a software developer for a very brief period of time in the 80s, but ultimately went to law school. After law school, I joined one of the first internet service providers as their general counsel, and we got very lucky to merge that company with what's now the largest internet service provider in Europe, Tiscali, at the height of the .com. And so I retired from the law that day, which was February 27th, 2000. And a few months later, I permanently relocated to Southern California. 22 years later, I'm still in Southern California. In 2000, we first set up a venture fund that was focused on voice of IP solutions and multi-massive online player games, which has a lot to do with the topic that we focus on today. Intermittently, I ran a startup that was kind of Yelp before Yelp between 2004, which we sold in 2008. In 2008, I took on some teaching positions and started to write ideas on the decentralization of the web. Ironically, I started a discussion group on Facebook on how to decentralize the web in 2008. So you'll find some of the reminiscence of that there today still. Then ultimately stumbled across Bitcoin and then Ethereum. And with Ethereum, I met my partner in the fund here for Sustany Capital, Carl. He created the Ethereum meetups here in Orange County before their ICO. We were one of the first allocators to that ICO. And we take a very scientific approach to the topic of investing. Usually we'll hear VCs use the term thesis as a synonym to a theme. For us, it's not a theme. It's an intellectual academic exercise. We write our own thesis papers, share these for peer review. And we look at every startup as an experiment on these ideas. So we ran our first fund out of our own book and proved out the thesis. We have 3 unicorns in our first fund and did really, really well raising our second fund right now. We have a separate entity that built hedge fund technologies for the last 4 years. We have a separate development group of 24 developers building DeFi solutions. We're launching our own non-custodial wallet later this quarter. We're doing our own NFT drop incidentally tomorrow while we're recording this. And we were the first fund to build NFTs. You can prove that by simply going back to our blockchain entries in 2018 in April when the first one was recorded with our logo. And so the reason why I'm in the space is I think what we're really doing right now is we're building the World Wide Web for the first time. So what people have been using up until now is the commercial web. Every time you're engaging with what you think is the World Wide Web, you're really on one platform, you're really the object or the non-player character in a game called Google or a game called Facebook, but you're not the agent, you don't get to set the directive. You're being social engineered more or less into doing certain things based on the objectives of that platform. And that's ultimately where I'm coming from. So intermittently, what's interesting is from a venture capital perspective, since we have now primitives that are natively digitally bearer assets, we can solve the problem that's all the money in the world And so it's the largest investment opportunity outside of the fact that we're fixing the World Wide Web as well.
That's very fascinating, what you've been telling us. I would be interested to learn more about your scientific approach to investing, because I know viewers of the channel are investors as well in many early stage token projects, for example. So probably they could benefit from finding more about your approach to this.
Yeah, and I'm somewhat of a contrarian in the space. I'm probably somewhat known for the statement, I think the number of cryptocurrencies we need is somewhere between 0 and 1. That's a lot of people don't understand current technology, but I'll explain why I claim that. It's a little bit provocative and a little bit cheekish, but the important thing to understand, so investing is all about timing, right? So we have a lot of sayings in our space. You don't want to invest into the first social media startup, you want to invest into the last. Being too early is the same as being wrong. We've been too early a lot of times. We were investing in the metaverse in 2001. I just published a video that we have from those days that we ended up spending $6 million on. We were trying to build the metaverse 21 years ago. But the larger point there is, if you're a technology investor, you need to understand the timing of technology. So there were many attempts to build YouTube before YouTube came around and was successful, to build a streaming service online. Obviously, it's very much useless if you have a 56K modem and it takes 90 seconds to load a page on Amazon. You can't really build a streaming service. So once broadband became a thing, then this particular solution could take off. And so what we see quite a lot is a lot of bets are being made on things that are definitely too early. And a lot of these projects already went by the wayside, but on a daily basis, I see people make bets on things that we definitely have identified as simply being too early. The larger point that being is you have to be able, in our particular case, and the focus that we have to be able to judge network topology based on its ultimate outcome. What I mean by that is that current network topology, as I mentioned earlier, basically treats every human being in the same way it would treat a weather station or an other IoT device, which means it will collect the data that this individual creates, it will copy it, distribute it, refactor it for the use case of profiling you on the platform that you're engaging with usually. And so the larger point that being is we're using things like what we call wallets right now to basically control bytes, right? So wallets are essentially browsers that browse a blockchain or another decentralized software solution, which is a more sophisticated term for the same subset of technologies, to then give you control over a set of bytes. And in that sense, all blockchains are the same, all decentralized software solutions are the same, and obviously bytes don't care if you call them Bitcoins or US dollars or CryptoPunks or CryptoKitties or anything else for that matter, right? So that's an important principle to understand. That's why to apply wholesale labels such as cryptocurrencies and so forth is very dangerous, because then you don't really understand the underlying principle. So the larger point that being, so in the context of the first implementation, so Bitcoin was trying to build peer-to-peer cash. And there's still to this day, I'd say 9 out of 10 and maybe more like 95 out of 100 people that I talk to can explain what a blockchain does. A blockchain does something very simple. It provides the ability to hand over control over a set of bytes from A to B without creating a copy. So it solved to make it very simple, it solved kind of the database problem. And so the larger point that being is, you asked me, so like, how do we evaluate these technologies? We have a particular investment horizon, right? So our investment horizon is usually 5 to 10 years. So we look at every solution from the perspective, what can this technology achieve at scale, our investment horizon of 5 to 10 years. And so initially when we formulated a thesis, what we should be focusing on, we just clustered all the large asset classes and the movements of value. So you have movements of value that people call remittance, you've got movements of value that people call payments in general, you got movement of value that has to do with creating mortgages, you have money market accounts. So I literally have a whiteboard here to my left where we had for a long time all these big buckets. And then eventually we settled on that idea based on the fact that we just look at the largest buckets. So the smallest buckets are $1 trillion or more. And then we decided, so what will the technology do, this paradigm, what will this paradigm shift do to this particular form of value creation, value transfer? And so if you look at something like payments, So payments has largely to do with moving bytes from A to B, right? So the default medium of exchange today is really bytes. So you swipe your credit card, you use an app, and you're moving bytes. Bytes, as I mentioned, don't care if they're green or red or blue. They don't care if you call them Bitcoins. They don't care if you call them US dollars. That's a function of your user interface. If you want to see the value of your Bitcoin in US dollar, then you choose that particular value. If you want to see the value of your particular holdings in Bitcoin in Chinese currencies or in the euro, you choose that. It's a user interface function. Larger point there being is if you look at the subset of payment, every digital bearer instrument solves payments with finality instantly if it chooses to, based on the user interface function. Meaning it's a function of the wallet, it's not a function of the cryptocurrency. And so anyway, but what's the logical consequence? Well, at the end of the day, payments should be free. Right now it's a $2.4 trillion industry, it might be 2.7 now. That should be zero, right? So because think about predecessors to protocols. And by the way, blockchains aren't protocols. I'll explain why they aren't protocols. But we invented the voice over IP protocol, SIP. And so the voice over IP protocol, SIP, didn't make phone calls more efficient, didn't make rotary phones more efficient. They replaced it entirely. They're a whole new technology. Just like SMTP is not a better way to create letters and stamps, it's a way to displace letters and stamps for most of communication. Larger point there being as so digital bearer instrument are just a wholesale approach to displace value transfer, and any type of specifics that is not just the simplest value transfer, which we call money. By the way, money is just an agreement between two people. And if we standardize these agreements, we call it currency. That's all that is. And anything else of value is just an additional set of metadata attached to that. So you can look at this from a technology in this perspective. So the larger point there being, though, is as an investor, you want to see how does this stack collapse and where does it collapse first? So there were countries that resisted the implementation of the voice over IP protocol, for example. So Mexico, quote unquote, outlawed voice over IP. And by the way, I put this into this air quotes because it's a very disturbing propaganda mechanism to conflate these issues, because no regulator regulates technology. Regulators regulate the behavior of people within their jurisdiction. So when they're saying they're outlawing cryptocurrencies, they're outlawing Bitcoin, they're outlawing mining, they're outlawing something, what they're really saying is, you citizens within my jurisdictions are not allowed to use technology in a particular way. And that's what they really should be saying. And then also the response would likely be different if they formulated it this way. So from an investment perspective, so we look at this from the angle of if you're implementing the technology as intended, so the original idea of, let's say, call it peer-to-peer cash, which we really don't have yet, unfortunately, in many ways. But if you look at this from that perspective, then if you're inventing this technology, if you're the creator of the voice over IP protocol, you don't have any regulatory exposure, right? And we are technology investors. What I don't want to see is I give you $10 million and you spend 5 million of that on legal fees, right? So that's the wrong way of thinking about the topic. Then you didn't usually apply the technology as intended. As I said, Skype didn't get any telecommunication licenses, right? So if you need a banking license to do what you're doing, you're becoming part of the problem in many ways. And not that this is not investable, it's just a matter of realizing, okay, is this a top-down approach, is this a bottom-up approach? What's the timing of the technology? What can we do right now? What can we do in 10 years from now? Anyway, I'm talking too much, but you always need to stop me, by the way, because for me, my problem is a lot of these things have been obvious for me for a decade. And I'm just so excited that more people are realizing this and that we actually now have the primitives to solve all that. That's why I said payments as a solved problem is one of those realities that is simply not evenly distributed yet. Governments around the world should make this free right now for their citizens, because money is really currencies. Government issued fiat currencies are really a public good. So you should implement them in the most efficient way. And the movement of bytes, by and large, is free.
It's probably very interesting to see how what you've been speaking for 10 years, for 20 years is slowly coming to become true. And you see other people starting to realize it. And probably from what you've spoken in the last few minutes, I have so many possible interesting follow-up questions to ask. The one I would firstly ask is what you mentioned on regulation. So you mentioned that the way you invest in technologies is that they don't, at least if I understood you correctly, that they don't have to be regulated because they exist, they sort of circumnavigate existing regulations. So I wonder,
Yeah, so
so they don't
there's two
spend all
ways.
this money on legal fees.
We invest, yeah. Yeah, so there's two ways to look at this. So there's entities that do like what I call top-down innovation. So they aggregate the existing, let's call it payment flows, value flows. And one example would be a company like Figure who released the provenance blockchain. Right, so we invest in that particular entity, in that particular project. And so what they do is top-down. So they needed to get these licenses and then they innovate top-down. It's not a paradigm shift, but it provides tremendous efficiencies. And then on the other spectrum, we look at cryptographic primitives, Web3 solutions, such as the graph. So we allocated to that particular project. And there you can see how it's a primitive that you will need to run dApps, and you can see the adoption of that. So that's both approaches. You just have to see what is the approach that's going to be most likely to be successful for a given team. So in the provenance case, in the Figure case, that particular team had the experience, had the reach, and raised an enormous amount of capital to do this top-down. But if you're a small startup of a dozen people maybe, and you're only raising $5 million, that is not a viable approach for you, right? So you're going to be bogged down with talking to regulators, figuring out legal concepts. So that is not a viable approach for that particular topic, right? For that particular team. You got to understand that part. And we see both, right? So we're seeing small teams that are trying to do way too much, and that's a typical problem. So they're trying to innovate all of payments rather than picking out one particular pain point and just solving that. And then at the same point in time, fall into the trap and get really bad advice, which has been my experience during the whole STO days and the whole ICO days. 99% of teams got really bad advice from law firms that explained to them the letter of the law rather than the objective of the law. And that's a common theme. The other common theme is a lot of times what we're talking about here is legal. So these teams are building legal technology. They're dealing with the transfer of rights or assets. Most of the time it's really rights. And you need to be able to understand these concepts, because the topic that we focus on that people call blockchain is living at the intersection of different disciplines. It's living at the intersection of computer science, of law, of finance, of incentives mechanisms, of economic scale, and so forth. And unless you learn the language of this particular discipline, you cannot actually formulate a thesis to begin with. You actually cannot formulate a useful white paper. 99% of the time when I'm talking to people, they don't actually have the vocabulary for me to have an intellectual discussion with them because they haven't learned the language of the space, right? So they can't explain what a blockchain is. People still confuse blockchains and DOTs. They confuse blockchains and protocols. Blockchains aren't protocols, they're state machines. Blockchains aren't used to store anything. And by the way, if you read the title of the Bitcoin white paper, you would know that, or at least read the abstract, if you don't want to read the entire paper, but then you would know that, by the way, the Bitcoin white paper never mentions a ledger for good reason. Anyway, I'm going to stop myself again here. You always have to stop me because I can talk for literally for 2.5 hours. I do now a webinar every month where I basically talk for 2.5 hours simply to address the most common misconception in our space, of which there are many. We are using a lot of useless metaphors that get people confused.
Why do you think it happens that even despite such a strong growth of the space, and despite so many highly educated technical people and legal people being involved here, there are still so many misconceptions and lack of understanding in terms of how blockchain works and how it is different from protocol and from other things you mentioned?
Yeah, I mean, a lot of the adoption has been due to money go-up technologies, right? People get into this and they invent a new unit of account. And it's very tempting. If you can create your own money, of course, that's a very tempting thing, right? So you can't fault people really for that. And then also, obviously, there's a lot of experiments in there. And basically, we are at this kind of state that I would call it's a massive multi-online player game right now, the entire space, which I don't mean this derogatory. I think that's a good thing. We should have done these kind of game scenarios before we implemented certain technologies and certain economic incentive systems, because most economic incentive systems are broken today, right? Fiat currencies at large are a scam. They're Ponzi scam. If you do the same thing, you go to prison, but somehow it's okay that governments can do that, which I wholeheartedly disagree with. But then again, we now have the technology to sidestep all externality of fiat money creation. But yeah, so back to your question is like, why is that? It's just enthusiasm and people coming at this mostly from an engineering perspective. A lot of the innovation in the space is driven by engineers, and they often don't realize that they're building legal technology. So I've reviewed thousands of white papers, and as I mentioned, I work with different standard setting organizations. I'm the co-chair of the Banking and Finance SIG at the Decentralized Identity Foundation, of the board position at the Open Travel Association, where we set the data exchange standards for travel. And so at scale, there's an ignorance about the existing functions and the existing systems and how they work, because very seldom do you have kind of this blue ocean greenfield opportunity where there's nothing in existence. And a lot of times in our space, you have to be able to be backwards compatible with the existing system to influence real world economic activity. So to make this more practical and more tangible, let's say you want to build a new dApp, a new decentralized application for the travel space, right? Travel space has very nuanced data exchange that developed organically over time, to the extent that some little outpost with some little airport in the middle of nowhere, I just landed on one of those, will still have a telex machine. Well, you need to know that these telex machines speak a format called EDIFAC. And if your system is not able to transfer your particular data as you being the passenger on that plane, and it arrives there on that telex machine in a certain way, then as a real world externality, they will send you right back home. And so there's a
then
lot
sounds to me like a lack of standard customer development that you try to do when you launch a business that has as a product that has a hope of being successful in the world. So anyway, you need to speak with the actual customers who will be implementing this. In tokenization space, I'm seeing also this happening a lot, when people confuse the actual innovation brought by technology and all of the other legal and financial innovations that existed decades ago. Securitization in the modern form exists from 70s, and crowdfunding and private placements have been around for quite a long time. So people often confuse, when they speak about STOs, the benefit brought by the technology itself and by other innovation that they are implementing here.
Right, and most people can't even explain a token. So a token is simply a standardized smart contract. That's all there is. So people then use metaphors like they're tokenizing real estate. That's the equivalent of telling me you took a digital picture of a house and the house is not digital. That's just nonsense, right? So you're just talking nonsense in that particular way, because you don't realize that the token is appear to be a bare instrument of a public blockchain. Right? So obviously you cannot tokenize anything that's not digitally native to begin with. It's just, again, a useless metaphor. But if a lot of people will introduce these metaphors when trying to write legal technologies. So that's why I actually started creating a GitHub library with just simply taxonomy that speaks to these legal concepts. And the most common confusion, and that's the most important topic, is to understand human agency, as in value is only value in the context of the individual or entity. Right? So if you have a bank account, you forget that you have it, it doesn't matter. Right? It might as well not exist. Same with your CryptoKitty or any other digital asset. So you need to be reliably assign ownership and possession and control. And those are all different concepts. And you need to know about those concepts, but you need to be able to assign this reliability to the individual. And unfortunately, because of the legacy implementations of these assets, 99% of the time, you will have to rely on the enforcement mechanisms of the nation state. Because the simple example I always make for that is, if you and I want to exchange a CryptoKitty for a Bitcoin, I send you a Bitcoin and you send me a CryptoKitty back, I can do everything using a smart contract. If I send you a Bitcoin and I expect to receive a real world kitty in the mail, and my real world kitty doesn't arrive in the mail, I cannot show up with my QR code and the blockchain entry to the local court of law and show that to them and tell them, hey, Boris didn't send me my cat and I want either my Bitcoin back or I want my cat. They're going to send me home, right? So the point there being is, all the value is really in the on and offboarding of real world economic activity to these systems, to the Zoom commercial activity coordination systems. That's where all the value is. And most of that right now, what we're doing is largely insulated. If you look at the DeFi space, it's only digitally native assets that are being traded, collateralized, and staked, right? There's no real world economic activity associated to that. Outside of the fact, if and when and where I offboard this for fiat currency, for example. And there's people that are—
Although I hope that over time, DeFi will become more related to real world economic transactions, at least to transactions with financial instruments that are tied to real world assets. If you can call it real world, given the certain detachment between large of the capital financial industry and the real economy that it is supposed to represent. Still, I believe that one of the most important implications and the benefits of tokenization, by tokenization meaning processing of transactions and change of ownership with securities and assets on blockchain compared to other systems, specifically that these tokens that, for example, represent shares in a company can interact with DeFi protocols. And therefore, you as an investor get more opportunities to get liquidity from interaction with these protocols or to additionally monetize those securities.
Yeah, unfortunately, for most real-world economic activity, we are many years away from that, right? So if you look at the largest asset classes, like your house, for example, we are years away from that because there are so many ingrained data silos, and there's so many incumbents that are attached to these data silos, and their livelihood depends on these data silos. They will fight tooth and nails to optimize these, right? So I've been there myself. So we financed a project that was trying to build universal data exchange systems for the travel space. But what people don't know, there's 3 incumbents that control the space that people have never heard of. And they have no interest of being disrupted. They have no interest of applying your new data standard to their systems because they don't have to exist, right? It's just like, I mean, really, the number of commercial banks that we need is close to 1. Right, most commercial banks don't have to exist. For my earlier example, so the problem that is payment is largely solved. Then the problem that is lending is being attacked from all different verticals. I look at them very much as dispatchers. Like the Uber app didn't reduce the number of dispatchers; it just made dispatchers obsolete. So you're dispatching new financial instruments if and when and where you can actually onboard real world economic activity. But I just had this discussion before this particular call. So if you want to onboard your house and so forth, you need to be able to onboard all the metadata with that to avoid like another 2008. And there are certain entities that sit on this metadata and they make a living from having this particular metadata, right? So from having the details about the house that's being collateralized. And unless—
So there is very strong incentives to combat the proliferation of this innovation that leaves basically many people without the jobs.
Yeah, so that's why the low-hanging fruits is always the part of the world where the economies haven't been financialized yet. That's why initially I thought about rewording the whole DeFi acronym to definancialization. It's actually really financializing the economies that haven't been financialized yet. And then what we're also doing is then we're optimizing the financialization of the legacy systems. At scale, we will just replace most databases and those that maintain these databases for something like a digital bearer instrument. So the metaphor, as I said, I'm not a big fan of metaphors, but it's really hard to talk in these generalities about these topics and people still understanding what I'm talking about. So if you look at a bank, for example. So they offer something in meat space and physical space, like a safety security box. So the way a safety security box is really cool, because you have your key, you walk into the bank, a bank teller walks with you into the vault, he or she unlocks that vault lockbox for you, then leaves the room, then you use your key and unlock the box, you take something out, you put something in, the bank never knows what is in that box, doesn't take possession of it, doesn't take ownership of it. And once you're done, you lock it up and the bank employee comes back in and locks it as well. So my point for that metaphor is that's the role that banks should play in digital space as well. That's the only role they play. So right now, they are social engineering people that they call their customers into acting against their own incentives, right? So the amount of money that's stuck in money market accounts and certificates of deposits in the United States now is enormous. It eventually last year exceeded the amount of money that's being owed in mortgages for the first time. And you probably know what the interest paid on this is way below inflation. So people lend the money to banks and lose money in the process. It's against their own interest. What they're doing is not.
This is what surprises me the most. The fact,
yes,
while so many additional investment opportunities that are at least not worse than bank deposits in terms of the risk are available, people still keep storing their money in the bank. This is one of the most fascinating things. When clients come to us and they want to offer investment in their real estate through tokens, this is a use case that we are often getting. One of the kinds of invest, and they are asking other investors out there who would invest in us. I reply, there are billions of people who hold their money in bank accounts and get interest rates that doesn't even cover inflation, while your asset is likely to have not be much worse in terms of risk, but often a few dozen times better in terms of returns. So this should be a clear win. And getting back to this discussion, you say but what I'm interested in is whether it is realistic to expect that this centralized system that trick people and collect their data, whether it's reasonable to expect that they will be defeated, because it seems that even in crypto, people tend to utilize and benefit from centralized platforms that innovate at a bit faster pace compared to protocols which are shared between many people and therefore are harder to improve, and that offer better things like user experience, for example. That is why people trade and invest through platforms like OpenSea, for example, or Coinbase, instead of more going through decentralized exchanges. And even when we're speaking about developers, there are like two companies who facilitate access to Ethereum. It's Infura and one more that I don't actually remember, which provide APIs through which all other developers access Ethereum instead of doing this themselves. So in this regard, even people who are often for decentralization really use quite centralized solutions. So is it possible that it will change?
So what you're really talking about is adoption, right? So, and that's one of my pet peeves, and has been a pet peeve for a decade now. I still get emails every single day: cryptocurrency adoption, blockchain adoption, DeFi adoption, blah, blah, blah. So this is always a completely incomplete statement. Adoption by who, for what, why, when? And so you have to tell me that, what's the use case? And then the other part is, if you say something like crypto adoption, right? That is nonsense. So people didn't adopt voice over IP. If you ask your mom, is she using voice over IP, she'll tell you, I have no idea, I don't. And then you'll point out that she's using WhatsApp or Skype, and she's like, but mom, you're using voice over IP. So the point here is, people don't adopt technology. People adopt solutions, they adopt applications. And so we're still not at that level, right? So we're kind of at the dial-up stages where you have to configure your modem to a particular dial-in number. You have to install a modem in your tower and so forth. That's where we are right now. So right now, the adoption is on the developer level. They're not on the user level. There's 5% of the world's internet population that even has a wallet. And that's very charitable. So out of that, there's probably maybe 10% that actually interact with the blockchain, because all the other ones just got a wallet, as you pointed out, for a decentralized for a centralized custodial exchange. And that's how they interact with a cryptographic asset, quote unquote, right? So a larger point there is adoption will happen if and when and where we have applications that people can actually adopt at scale and not need to know a new language, right? So the worst thing you can do to prevent the adoption for your application is invent a new language, i.e. create a new unit of account. So now you have to explain what your gobbledygook token does that's different from the US dollar. That's the largest friction you could ever introduce for the adoption of your application for a normal user, obviously. So a normal user most likely will adopt a wallet that has a trusted logo on there, and it just happens that it can interact with digital bearer instrument. That's when you will see adoption, right? Once you build these end user applications. And we're just still very, very early.
I tend to agree, and it seems that in the last few years there have been more understanding that things like user experience and applications that are easy in terms of onboarding and usage are really important for adoption to happen in any kind of space. So I hope we will see it more in the next years.
Yeah, so what I tell developers on a daily basis is users don't expect the user to adapt to your technology. Adapt your technology to the user, right? That's what you need to do. And that's kind of an obvious thing, but on a daily basis, I'll be talking to some engineer and he'll tell me, oh, you only need to do this and that and this, and then you can pay. It's like you only need to buy some ether and then you deposit it into this contract and then you learn what XYZ does and you install this plugin and then you get a code. It's like, you really expect that your mom and the world at large is going to do that? It's like, no, focus on the low-hanging fruit. Create NFTs for dry cleaning receipts. Don't create yet another digital collectible.
And that is why you, in the solutions that you invest in, you also try to focus on those who are more likely to offer a simple user experience and therefore have higher potential for adoption.
Again, it's always who do you expect adoption by? I mean, if you're the graph, then your particular solution is being adopted by developers to build apps. And so I buy into that, right? So that's useful. If we invested in some CeFi solutions too, because there was just a need for that. You could see the adoption that people wanted to have a trusted entity that they locked their crypto holdings into to borrow against it, right? So most people feel more comfortable. That's why the decentralized lending space is half the size of the centralized lending space, right? Because most people just don't trust themselves, just don't trust some new protocol that just came around a year ago and want to log in more than $10,000 or whatever is relevant in their life, right? So it's unfortunate, but it's the reality, right? So most people live in a state of learned helplessness, and they are being indoctrinated into the idea that fiat currencies are money, that they are stores of value, when that's obvious nonsense, right?
Chris, thank you for this fantastic interview and for the insight that you brought. Before we wrap up, what would be briefly your main advice to people watching this interview who are probably going to be entrepreneurs interested in leveraging opportunities in the blockchain, Web3 and DeFi space, who may come from many very traditional industries like real estate or natural resources, but want to get into crypto as well?
Yeah, so first of all, learn the language of the space. It's really hard. So I have this saying that I use on a daily basis: reality doesn't have an advertising budget. So almost everything you find online about the topic of blockchains, cryptocurrencies, and so forth is just some form of motivated reasoning. So advertising copy, it's not reality. So mind your sources. So look at the source, whoever's publishing something, and then decide for yourself, should I trust this particular source? That's one. Then the second one is learn the basic principles of the space. Learn what blockchains actually do. and where they fit into the stack. There's unlimited opportunities right now for people who understand what problem is being solved. And so the largest problem here, by the way, is simply that of data security. So the damages from cybersecurity breaches last year exceeded $6 trillion, which is 3 times the size of the entire cryptocurrency market. At the core, these are externalities of database-driven solutions because you cannot protect databases. So there's an unlimited number of opportunities for you to develop solutions that implement NFTs, that implement new onboarding techniques, that implement these primitives in an application and simply provide a more secure and more efficient solution to a very particular problem. Look at a very particular problem, try to solve your, we have the saying of scratch your own itch first. If it's useful to you, it's probably useful to others. Don't create an esoteric problem. Don't double down on the existing system. Don't invent a unit of account, right? I mean, we invest in tokens as the exception, but as you probably know, most tokens don't have a reason to exist. And oftentimes, if and when you introduce one to your particular application, it actually defeats the purpose of your application to begin with, right? And so that's why you see changing narratives around Ether, for example. Ether was initially a DDoS mechanism or DDoS protection mechanism. Now it's quote unquote super sound money. That's nonsense. That's just a false narrative, right? Money is an agreement with between 2 or more people. And if you standardize them, then it's called currencies, and the unit of account for Ether is the US dollar. And otherwise, the default medium of exchange is byte. So realize these very obvious observations, learn the primitives of the space, learn the principles of the space, mind your sources, go to the original OGs and what problems they were trying to solve. Like inhale the Bitcoin white paper once you read it again, and realize what is the problem that's actually being solved. Not the problem that people are propagating, not even the problem that's on the title. Observe what's actually being solved. And you can, that's the benefit of our space. If you have a public ledger, you can readily observe it for what people are using it, right? What's the use case for Tether? People keep saying nonsense like stable coins, like trying to apply a broad label to that. You can simply observe the use case of Tether. Tether's use case is to stay on a centralized exchange and speculate against BTC. That's its use case. And it solves the problem of going into fiat and creating a fiat penalty in form of a fee. That's the use, and you can just measure that. And within that particular use case, the utility is great. The utility is about 100 times that of the US dollar within that use case. So don't think of it as like something very broad. Pick a very particular use case, solve this particular use case. Don't invent a new unit of account. We don't need more units of accounts, we need less.
Awesome. Thank you for this presentation. It was a pleasure to speak to you. As for our viewers, don't forget to subscribe to the channel to watch other amazing updates, that we will have another interviews that will help you to build better solutions and raise capital better from different kinds of investors. With that, stay tuned and see you in the next interview.